Welcome to StockStudio, a podcast about investing that, blends useful analysis with a bit of humor.
That's the plan.
Today, we're diving straight into Berkshire Hathaway. Ticker is BRK.A, of course.
The big one.
Exactly. You sent over that fresh analyst note, May 3rd, 2025, and some other reports. You wanted the quick take on what the smart money is thinking about this giant.
Yep, trying to cut through the noise.
So let's unpack the key insights, make it digestible.
Sounds good. Where should we start? The price.
Yeah, let's start there. What's the latest?
Okay, so as of May 2nd, 2025, BRK.A was trading around $809,350 per share.
Right. Not exactly pocket change.
Not at all. But here's the interesting bit. Morningstar's fair value estimate, this is from late April, April 24th, they put it at $730,500.
So a gap there, about 11% overvalued based on that number.
Exactly. A price to fair value of 1.11 suggests the market's seeing a bit more value or maybe optimism than Morningstar's analysis currently justifies.
And this estimate held even after the Q1 earnings came out.
It did. Gregory Warren, the analyst, kept the fair value the same, said the Q1 results were pretty much in line with what they expected.
Okay. So the earnings didn't cause a big rethink on value. What were the highlights or maybe lowlights from that Q1 report?
Well, the headline revenue number looked a bit rough. Reported revenue dropped 9.2% year over year, down to $83.3 billion.
Ouch. What drove that?
A big chunk, like $6.4 billion, was from investment losses and some other adjustments. You know how market swings can affect their reported numbers?
Right, the paper losses and gains. What about the actual operations?
If you strip out those adjustments, operating revenue is actually pretty flat. It declined just 0.2%, landing at $89.7 billion. So the core businesses held up reasonably well overall.
Okay, that's a much less dramatic picture. But profitability must have taken a hit from something. You mentioned expectations were met, but earnings must have moved.
They did. Operating earnings before those adjustments, so looking at the businesses themselves, they decreased by 14.1% to $9.6 billion.
And the reason?
The main culprit was significant insurance losses. Seems the Southern California wildfires really impacted them.
The downside of being a massive insurer. Big events hit the bottom line.
Exactly. And if you include all the adjustments, the reported operating earnings number fell quite sharply, down 63.8% to $4.6 billion.
Wow, that shows the impact of both the insurance losses and those investment figures.
Definitely. But there's another key metric for Berkshire book value.
Right, often seen as a decent proxy for their intrinsic value growth, given their structure. How did that look?
Pretty solid, actually. Book value per share went up 0.8% just from the end of last year, and it's up 14.4% compared to Q1 of 2024. It reached $455,055.
Okay, so even with those earnings hits, the underlying asset base is still growing nicely year over year. That's reassuring.
It is. It shows the overall portfolio continues to build value.
Now let's talk cash, the famous Berkshire cash pile. Still growing.
Oh, yeah. They set another record. Ended Q1 2025 with $333.3 billion in cash and equivalents.
$333 billion. Just rolls off the tongue. How much did that grow in the quarter?
It was up from $321.4 billion at the end of 2024, so added about $12 billion. And free cash flow for the quarter was $6.2 billion.
So cash is pouring in. What did they do with it? Big buys, buybacks?
Actually, neither.
Yeah.
They were net sellers of stocks in the quarter, about $1.5 billion worth. And perhaps more surprisingly, they didn't repurchase any of their own shares.
With the stock price elevated compared to that fair value estimate, maybe that makes sense. They didn't see it as a bargain.
That's likely the thinking. It leaves them with an absolutely enormous amount of dry powder cash ready to deploy. Beginning Q2, that was estimated around $292 billion.
Nearly $300 billion just waiting for an opportunity. That's almost a problem, isn't it? Finding places big enough to invest that much money effectively.
It's definitely a challenge. A high-class problem, maybe, but a challenge nonetheless. For you as an investor, it raises the question of how effectively they can deploy it to generate future returns.
Good point. Which brings us to the moat. Berkshire's competitive advantage. It used to be considered wide, but that's changed.
Correct. Morningstar now rates it as narrow. The thinking is, historically, the collection of operating businesses together had a narrow moat.
Like BNSF Railway or their utilities.
Exactly. But it was really Warren Buffett's genius in investing and allocating all that capital that elevated the whole company to a wide moat status.
So the downgrade reflects the Buffett factor, concerns about post-Buffett returns.
That's a big part of it, yes. Concerns about future investment prowess once he eventually steps down. Plus, maybe some slight erosion in the moats of a few of the underlying businesses themselves.
Can you give an example?
Sure, think about insurance, like Geico. Insurance is tough for wide moats because the product is largely a commodity. Geico's direct model gives it an edge, a narrow moat, but it's not unbreachable. BNSF has a wide moat, hard to build a competing railroad.
Right. High barriers to entry there.
And Berkshire Hathaway Energy has a narrow moat, typical for regulated utilities. Many of the manufacturing and retail businesses they own also have narrow moats. Good, solid businesses, but maybe not impenetrable fortresses.
So a collection of mostly narrow, some wide moats, but the magic allocator overlay is seen as potentially diminishing over the very long term.
That seems to be the assessment reflected in the downgrade from wide to narrow overall.
Okay. What about risks and uncertainty generally? Is it still seen as a pretty stable ship?
Yeah, Morningstar's uncertainty rating is still low. The core risks are what you'd expect. Insurance claims being higher than planned, maybe some investments don't pan out, regulatory issues in sectors like energy or rail, and just the general economic cycle hitting their varied businesses.
And the elephant in the room.
The key person risk, definitely. Charlie Munger's passing was significant, and Warren Buffett is turning 95 this August. That transition is, a major factor investors have to consider regarding future capital allocation and investment strategy.
It really highlights the incredible impact over the decades.
Absolutely. Which leads to capital allocation itself. Still getting top marks there.
Still exemplary. I mean, Buffett's track record of aligning with shareholders is legendary.
Can't argue with that.
And as we discussed, they have huge cash reserves. Historically, they've preferred putting money into stocks, bonds, acquisitions, and buybacks over paying out big dividends.
Right. And while buybacks paused in Q1, the expectation is they'll probably resume when the price looks more attractive to them.
The challenge remains finding those huge needle-moving deals, though. Gets harder the bigger you get.
It really does. Especially deals that meet their value criteria.
Okay, so let's tie this all together. We've got a stock trading above fair value, a moat rating adjustment reflecting future uncertainties, huge cash piles waiting.
Yeah.
It's still fundamentally strong businesses. What's the strategy for you, the listener?
Well, given that overvaluation relative to Morningstar's estimate and acknowledging the long-term transition questions, a bit of caution seems sensible. If you already own Berkshire, holding seems reasonable. It's still a collection of very strong, mostly moaty businesses with incredible financial strength. But maybe don't rush to add more shares at this specific price level.
So hold if you have it, but maybe wait for a better entry point if you don't.
Precisely. Keep an eye on how they manage to deploy that massive cash pile. Are they finding good opportunities? And watch how the leadership transition unfolds over the coming years. If you're looking to start a position, aiming for a price closer to that $730,500 fair value estimate would seem more prudent from a value perspective.
Makes sense. Be patient. Okay, time for a bit of levity. Why did Berkshire Hathaway refuse to buy that trendy new tech startup?
Like guess. No earnings.
Close, because it didn't have a sustainable economic moat, just a lot of hype.
Okay, that fits. Needs more than just buzz for Buffett.
Exactly. So quick summary, Berkshire Hathaway, still a giant, still solid, but currently looks a bit pricey according to this analysis. The cash situation and leadership succession are key things to watch.
We hope this deep dive gave you a clearer picture for your own investment thinking.
Remember, doing your homework, understanding the fundamentals, that's crucial.
Your curiosity really is your best asset in investing. Keep digging.
Keep learning and keep investing wisely. And to wrap up, today's motivational quote, fittingly from the man himself, "The best investment you can make is in yourself." Warren Buffett.